So I'll just start out. Thank you all for joining us. Welcome. Appreciate you taking some time out to attend our webinar. Tonight, I'm joined by Dan Valenti, our portfolio manager. We're going to be spending about 30 minutes or so reviewing our alternative income fund 2. And throughout the presentation, you can ask questions. There's a little chat button. Should be able to see that most likely on the bottom of your screen. You can direct any questions to Dan, and then we'll leave some time at the end to go through and answer them all. So maybe Dan, why don't you start and give us a quick introduction, share a bit about your background with the group tonight.
Yeah, thanks, Mark. Great to be here. Great to see everybody. A little bit about me. My career started in the audit practice at PwC, where I got my CPA. And from there, I hopped over to banking at Citigroup, where I spent the last 15 plus years doing various roles in risk management and interest rate portfolio management. So there I was responsible for the bank's short-term funding, hedging interest rate risk, managing the bank's short-term bond portfolio. And, you know, I've always had an interest in real estate. I purchased my first rental property back in 2006. And since then, I've managed single and multi-family rentals. I'm very excited to join SMK as a portfolio manager where, you know, I'll be managing existing deals as well as new acquisitions. And, you know, I should mention that prior to joining SMK, I was also an investor and plan to continue doing that. And I'm really looking forward to just helping people achieve their financial goals through passive income and growth.
Awesome. Thanks, Dan. So tonight, we're going to start with an overview of our asset classes. As a reminder, our fund combines both mobile home parks and self-storage facilities. And you know, each of these asset classes has been a big part of our focus for the past 10 years. We believe they have a very high likelihood of performing well over the next 10 years as well. And so let's see here. We are projecting investor returns of 15 to 19% average annual ROI with a 7 to 10% average cash on cash. Okay, let's dive in. So as a brief overview, we have a unique investment offering for accredited investors to diversify capital across a pool of mobile home parks and self-storage facilities. The objective of the fund is to provide investors direct access to growing portfolios of cash flowing property and just a really highly diversified investment where we're spreading capital across multiple assets, regions, and operating partners. Our fund will be investing across 2 best-in-class real estate operators. They have successful track records in acquiring, improving, optimizing, and managing each asset class. And we're going to be focusing on value-add strategies across the portfolio. Really, the goal is to grow net operating income through various measures, improving operations, reducing expenses, and improving the properties and communities. So let's review some of the key investment benefits. We are a professionally managed fund focusing on capital preservation and downside protection. We're combining lowly correlated recession-resistant asset classes for passive investors to access. Again, diversification, a big focus for us across regions, properties, and operating partners. And we're targeting assets that generate both current income and those that have an opportunity for appreciation. We're focusing on creating a very attractive risk-adjusted return and wealth creation. And we find that these asset classes and our strategy are really a great hedge against inflation through asset valuation growth, income growth from rent increases and expense reimbursements, and also depreciating debt. You know, during inflationary times, the value of a currency is declining. Essentially, the same dollar today buys you less in the future. And so there's a slight benefit there for borrowers who can pay back lenders with money in the future that's worth less than what they originally borrowed it at. Another benefit here, you've got mobile home parks and self-storage tenants are very much less price sensitive compared to other asset classes. And we'll dive more into that in a minute as to why. And lastly here, we're always focusing on tax benefits. Here we've got some very favorable advantages through accelerated depreciation and cost segregation, which flows through to investors. Let's review our offering. We've got 3 class shares, starting with Class C, which is a $50,000 minimum, going up to Class B for a $250,000 minimum, and Class A of a $500,000 minimum. You can see the preferred return for each class below here. Essentially what that is a rate of return that investors need to earn annually before we, the manager SMK, participates in the cash flow and profits. And so it's essentially a performance-based structure here. And the profit split to investors above the preferred return, you can see ranges between 70 and 80%. The projected average cash on cash, again, 7 to 10%. And the equity multiple, 2 to 2.3x. Again, we're trying to double money for investors across the portfolio in the term. We have a projected average annual return of 15 to 19% as well. Okay, so asset management fee is 1.25%. That is an annual fee based on capital invested, and we have a one-time acquisition and disposition fee of the same. Our investment term is 5 to 10 years, and we are projecting that principal will begin to be returned to investors in years 3 through 5. It's very much in correlation with our value add strategy at the asset level. It takes a few years to implement the value add strategies, and usually around years 3 to 5, you're seeing the completion of that strategy, which often will result in some of the properties being sold or refinanced, at which time we anticipate returning capital to investors and continuing to hold for cash flow. We're going to be doing investor distributions quarterly, and you can see our projected annual cash flows. These are distribution projections to investors. We're starting out in the earlier years in 3 to 6% as the value add measures of the properties are being implemented. And then they're going to be projected to be growing 7 to 10% years 3 through 4, and then 8 to 10% plus from year 5 onward. All right, let's talk about mobile home parks. Again, we've been investing in this asset class for over 10 years. It's one of our favorites today, remains favorite. And here's some reasoning as to why. Again, demand, you have a increasing, growing demand for affordable housing. This has been a big part of our thesis for a long time here. We're estimating that 17 million people live in mobile homes, and it's one of the most affordable housing options in the US. Limited supply, which is a very unique, attractive advantage of this asset class. We have a slide in a minute, which we'll share with you, but essentially there's very little, if any, new supply, and the net result of new supply in mobile home parks is often zero based on data that we've seen. A lot of communities often can create a higher tax income by demolishing them and putting in higher density use real estate. And so we're actually seeing this supply for mobile homes flat or declining, which is very unique to the asset class. Tax benefits we quickly covered. We've got 15-year depreciation schedule for land improvements, which is much faster than some other types of real estate. There's a lot of market inefficiencies in this asset class. The majority of mobile home parks are owned by mom and pop operators. A lot of them don't manage the properties or communities very well, and that provides an opportunity to bring in professional management, more institutional designed operations to create value and improve operations. Very unique business model that we focus on. A lot of the mobile homes in our communities that we're investing into are owned by the residents, and then they rent the land from us, the mobile home park owner. And so that results in a pride of ownership amongst the tenants, the residents, the community. and oftentimes a much lower maintenance cost, where we, the park owners, aren't responsible for maintenance and upkeep and repairs on the homes. It also results in high resident retention. There's just not a lot of options, affordable options, and it's quite expensive to move a mobile home. $5,000 to $10,000, and the lot rent might be $200 to $500 a month, so pretty prohibitive to move. There's actually some data saying 90% of mobile homes are never moved, and it just provides a lot of stability and predictability from residents in this asset class. Okay, let's talk about self-storage. Again, one of our favorite asset classes for quite some time now. There's some benefits here. Long-term tenants, you've got a low average cost, usually around $100 or less for a 5x10 climate-controlled unit. So it can become difficult and cumbersome for someone to switch and move their belongings from a self-storage facility to another one down the road, just to save, $10, $15, $20 a month. We actually have found that the average tenant duration is 14 months, and 46% of users stay 1 to 10 years. And so it's a very sticky asset class when it comes to tenants. Short-term rental rates, big benefit here. Contracts are month to month, and so you can adjust rates, rental rates, on a very short notice, within 30 days. It's a very attractive benefit now during inflationary periods, where you can grow rent pretty quickly and keep up with inflation, or even beat it. And I think the only other asset class that might be shorter term than this is, of course, hotels. And we don't invest in hotels, but we love self-storage, and this is one of the benefits of shorter term contracts. Historically, it's been one of the lowest delinquency rates of all real estate sectors. And it's got a long track record through multiple cycles of consistent performance. We'll dive into some more of that in a minute here, and you can read some of the data points here, but continues to perform very well during all different market cycles. It's a low overhead business model. Operating expenses are lower than most other real estate. If you think about what it is, there's usually very little, if any, plumbing, electricity, gas, you name it. And so utility costs, again, during inflationary times, not having a very big operating expense there is very helpful. And the facilities are often pretty easy to maintain. You can see, 2 full-time staff managing effectively 1,000 units. We talked quickly about limited capital expenditures. If you have a lot of turnover, you can see that capital expenditure cost go up. And so we try and focus on these asset classes that have very limited turnover. If you think about self-storage and mobile homes, as we just noted, for self-storage, somebody moves out, you can, clean it out and broom sweep it and re-rent it out within an hour. And then, as we mentioned before, mobile home parks, the residents often own their homes and they tend to stay there a very long time. So the result here is very attractive profit margins. Now, this is a great chart we love to talk about and share with folks. This is billionaire Sam Zell's Equity Lifestyle Properties. They're the largest owner of mobile home communities in the US. Essentially, what we're looking at here is a chart showing how their portfolio has maintained positive net operating income growth. This is the line in orange through all quarters. This goes back to 1998. So even through recession. So really just a really great example of how this affordable housing option remains resilient through economic downturns. And here we're looking at mobile home park rental rates and occupancy trends dating back to 2007. Again, you can just see the consistency. In red is the rent, and in black is the occupancy. So very predictable. Again, quite expensive to move a home, and turnover is quite low. As long as you're being fair with residents, they tend to stay. Self-explanatory chart here, just long-term trend of demand for self-storage in the US. This goes back to 1987. So today, roughly 1 out of 10 US households uses self-storage. Now, in recent years, self-storage has experienced a lot of new construction. You can kind of see in blue here the ramp up. This is completions square footage. It's resulted in a lot of markets suffering from oversupply, and that's one of the biggest risks in self-storage. They go up quick, and they're very the cost to build them is one of the lowest options out there. And so we saw this ramp up through 2018, 2019, where it peaked. And then you can see the drop since then for a lot of different reasons. New construction is essentially slowed. And what we're seeing in orange is the vacancy rates. And so right now, vacancy rates are at the lowest level on record. And so really just a great time to get into the asset class. We do anticipate that once supply chain bottlenecks free up and potentially material costs stabilize, we'll start to see more storage in the next several years. And so again, pointing to the timing here, we believe it's an opportune time to get into the asset class. Now we want to talk about some of the performance of these asset classes through COVID, right? We talk a lot about recession resistance, resilience. Each asset class was tested in 2020 through the pandemic. And so we're looking here at the mobile home park and self-storage valuation growth. And this is as of January of 2021. So you're looking essentially at 2020. And we like to go back to 2020 and look at data because Q2, Q3-ish was a peak unemployment. It was when everyone was staying home, not working, and a really good time to evaluate how things were going as far as performance of commercial real estate asset classes. And what you'll see here is, at the end of 2020, mobile home parks were number one across all asset classes for valuation growth. And self-storage was, essentially unaffected. And so again, a good look at the perseverance and resilience of these assets during the peak of the pandemic. Now, if you fast forward a year later, you can see what happened. The word got out, of course, and everybody wanted to invest in mobile home parks and self-storage. So you got very, very high rapid growth on valuations. This is, again, 12 months going back over 2021 or so. And so very fast appreciating asset classes. We still find there is a lot of room to grow here, especially using value add measures that we'll talk more about in a minute. This is just a good chart. Again, in September of 2020, during the peak of the crisis or so, Green Street Advisors came out with their projections of 5-year internal rate of returns across 10 different asset classes. And you can just see kind of the spread here and pretty self-explanatory. So again, good to see that during some of the most uncertain time of 2020. And then going back to new supply trends. Green Street tracks this. We look at this constantly. You'll see here that historically and looking forward for mobile home parks, again, there's just no new supply. It's one of the major unique advantages of the asset class. It's very hard to build a new mobile home community in a desirable location due to zoning restrictions and prohibitive costs. And self-storage, as we previously noted, is also projected to have lower annual completions looking forward, and this goes out to 2025. So again, pretty good, lack of supply coming onto the market. All right, so our fund's going to be investing into 2 established and growing portfolios with separate operating partners, and our operating partners are one of the most critical aspects to our success. Their role is to acquire the properties and execute on the business plan. And we focus on partnering with operators that have an established team, both in the back office and on the ground, handling day-to-day operations. We tend to prefer vertically integrated firms where they have property management and asset management in-house. It allows us to capitalize on some economic efficiencies there. And now, if you log into our investor portal on our website, you can access a lot more information here about our operating partners, who they are, their track records, their investment strategies. I've also shared some interviews that I did directly with each one of them, so you can listen to those. And again, just go to the portal. You can log in there and access a ton more information on our operating partners. For now, I want to review the portfolios that we're going to be investing into. So the first portfolio investment we're going to be making in our fund is into a portfolio that already consists of 5 mobile home parks and 13 self-storage facilities across 14 states. You can see them highlighted in blue. The portfolio provides us with immediate and significant diversification, something we're definitely looking for our fund, across 1,000 mobile home lots and 6,000 self-storage units. As of the close of Q3 2021, our operating partners had raised a little over 90 million of equity. They had deployed 88 million of that into assets in this portfolio. And so the business plan now is to add an additional 30 million of equity because they've got more acquisitions in the pipeline. And I'll share with you how they source deals in just a moment. But essentially what's happening here is this portfolio was opened in the middle of middle of 2021, around end of Q1, early Q2. And they've already raised 90 million, deployed 88 million. Now they're going to add another 30 million to it. They've already raised 60% of that 30 million as of last week. And so we anticipate that this is going to close in just a matter of weeks. And we want to be some of the last capital in. With our structure and relationship with our operating partners, we're able to earn more favorable terms for our investor group. This includes a higher preferred return and a higher split above the preferred return. Also important to note, our company and our family combined, we've got already a 7-figure active investment in this portfolio. It's going very well. We're quite excited about it and looking to add more capital to it before, again, it closes in a few weeks here. Let's review some highlights here. 90% of the assets are sourced off market. So a very strong competitive advantage in today's marketplace where it's really hard to find good deals. Our operating partners are co-investing about 4 million of their own personal capital into this portfolio. That is a requirement that we have of all of our operating partners, is to co-invest into the deals. As of the end of 2021, the fund had a loan to value of just over 15%. So this is a really good opportunity to increase future investor returns through the use of a new credit facility that they recently closed with KeyBank. And this credit facility with KeyBank is now going to fund future acquisitions to the tune of 65% maximum loan to value. So very conservative debt. And the rate today is roughly around 3%. So very attractive debt terms coming into play now into this portfolio to enhance and hopefully improve even further the projected returns going forward. Performance-wise, collections and occupancy as of the end of Q3 were 90 to 93%. That's across mobile home parks and self-storage. So essentially what this portfolio is they're acquiring predominantly stabilized assets, stabilized in the form of high occupancy at the time that they buy them, but they're underperforming. There's a lot of levers we can pull, mismanagement and some below market rents, oftentimes, to grow the value by operating it more efficiently. It provides both income and growth with this strategy. Our operating partners have projections for each asset, typically around 20% internal rate of return at the project level and a 2.5 equity multiple. So attractive returns that definitely meet our investment target. So, when we look for an operating partner, we really focus on finding groups that have a competitive advantage. What are they doing that's unique, that's different, that we can take advantage of, essentially? We really want to separate operating partners and have a relationship with those that we think have the very high likelihood of meeting or beating projected returns and reducing risk. And so this operating partner, one of their special sauces, unique competitive advantages that they have, that they've built over the years, is how they source deals. And so they have an in-house acquisitions team of 7 full-time people. All they do all day long is target off-market deals. cold calling, mass marketing. They're doing a lot of outreach to mom and pop owners of mobile home parks and self-storage. So for example, they did a recent text campaign initiative. They were targeting a specific market that they already have assets in, and they want to expand and buy more assets in. They sent out 635 text messages in a matter of minutes. They got a 13% response rate. This is, again, direct to the owners of the assets. And so this process allows us to kind of do two things, right? One is you're avoiding competition because you're most likely going to be talking direct to the seller. Two, you probably are saving a little bit of money through the potential lack of real estate fees for agents, et cetera, and hopefully getting a better deal than you otherwise would have. And so to summarize what they're doing, last year they made over 130,000 outbound calls. They offered on 120 properties, and they got 30 of them accepted through their deal sourcing strategy. So we love this. We want to take advantage of it and be a part of it and continue to invest here. Let's look at a case study. Okay, this is the same operating partner, self-storage case study. And we're looking at October of 2020. Again, that's a very pivotal time frame for us to look back and see how are things going. And so this is a two-property portfolio that they sold in October of 2020. Essentially, what they were able to do is they created a lot of value growth. They implemented various value add strategies across the two portfolios here, the two properties. They raised market rents. They also added 69 new storage units. And so there was an expansion done here as well. And the result of this value creation and buying off market was just outstanding returns to investors. And you can take a look here, but essentially they bought the two properties for $2.5 million in 2016 and 2017. And they sold them in October of 20 for $6.6 million. Again, that is at the height of the pandemic. And so maybe they should have held them longer, who knows, but a great return here. Value creation, this is really what we're looking at, is the net operating income. They were able to increase it $175,000 annually, which is pretty substantial for a $2.5 million acquisition. It ended up with a project level IRR of 82% and a project level equity multiple of 3.6x. So again, historical performance is not indicative of future results, but happy to share a home run here with you. Okay, let's shift gears. Let's talk about our second portfolio investment that we're going to make. This second portfolio is into a mobile home park fund, and essentially already owns 12 mobile home parks across 7 states. We've got over 1,000 lots, and the opportunity here is to get immediate and significant diversification. Same strategy. We have our operating partners that have already built out this portfolio. They're expanding it a little bit more because they also have acquisitions in the pipeline. So a very similar business model here. They'll also be co-investing about 3% of their own capital into the portfolio. Now, the business plan here, we're projecting that cash flow from this investment will start after about 18 months. And then there's a lot of opportunistic value add here. And so the business plan is to return principal through refinances and sales by year 5, and then continue to hold the remaining assets for cash flow. And again, here we were able to negotiate more favorable terms for our investor group, including a higher preferred return and a higher split above the preferred return, just really favorable economics that flows through to investors. Also good to point out, we already have an active investment in this fund consisting of $500,000. It's going quite well, and we're excited to add more capital to it before it closes in the coming months. A few highlights here. Again, our operating partners are focusing on opportunistic value add mobile home parks with high projected valuation growth. The average year 1 cap rate of the current properties in the fund is over 9%. So a very attractive going in cost basis here. And as of the end of 2021, the loan to value was at 70%. Again, quite conservative amount of debt. Now, as far as performance goes, cash flow distributions to existing investors, including us, because we're in this fund already, are beginning about 1 year earlier than projected. So as I noted above, we're anticipating 18 months. We're still anticipating 18 months to get our cash flow. But what they've been able to do already is speed that process up pretty significantly. We want to, of course, remain conservative and just keep the expectation at 18 months, but we're excited to see the performance ahead of schedule thus far. And we've got about a little over half of the properties in the fund were bought over 6 months ago. So it just provides us an opportunity to step into any potential appreciation since they were acquired and some of the value add measures that have already been implemented. A really important point here too, our operating partners haven't raised rents in this portfolio yet. They are going to be doing that in just 2 weeks here on April 1st. Now, this rent raise is across the portfolio. It's 1,000 lots, so it's between $25 to $50 or so, give or take on average, per community. Now, the result of this is that you're going to see net operating income grow by around $57,000 a month. So very substantial amount of valuation growth in a short period of time. Again, a big benefit for investing into this portfolio. Some of the last capital in, you can see how things are going. You can see how they're trending based on projections. Again, before the portfolio is closed in probably in a few weeks, maybe a month or so before this one's closed. Let's look at an example. This is a property that is in the fund that we're going to be investing into, and it was acquired in May. It's an 87-lot mobile home community in Alabama. They've been able to make a lot of progress already here. They have turned over a lot of delinquent residents. Delinquency's been reduced by over 50% since they acquired this community. And it was a problem that the previous managers and owners were not able to solve. And so this is a focus of our operating partners, is what they specialize in. They're taking, I would call it semi-distressed, a little bit more heavy lifting parks and turning them around. And so let's see what they've been able to accomplish so far. So regarding delinquency, you can see this chart in blue where it was at acquisition, and they again have dropped it by over 50% in a short period of time. In addition, they've renovated a new office. They've paved the roads. They're renovating and filling used homes. And the business plan calls for increasing occupancy from 67% to 95% by year 3, and selling homes to residents through a rent-to-own program that they facilitate. Today, we have 57 paying tenants. That's up from 36 at acquisition. And they've already sold a quarter of the projected homes, 7 out of 28, through their rent-to-own program. So a lot of progress in a short period of time. Now, projections, the lot rent at acquisition was $250 a month. Their pro forma was underwriting lot rent to go up by about $25 in 2022, and then increasing slowly thereafter till $315 a month by year 4. So what they've seen, though, as a result of their new management and some of the value add that they've already created, improving the aesthetics, the appeal of the community, they have a very high demand. So they're actually going to be increasing lot rent to $310 per month, again, effective in about 2 weeks. So based on this, this is a great example of some of the pace of their value add beating projections pretty substantially. This community was bought for a little over $1.3 million in May. The price per lot was $14,600, and projected sale price is over $3 million. And that would produce a project level IRR of over 18% over 10 years. So really excited about the progress that we've already seen implemented at this property in the fund. Now let's review a case study. So same operating partners, again, focusing on more opportunistic value add. So in November of 2019, they closed on the refinance of 2 of their portfolio properties. The parks totaled 240 lots. They were in Phoenix City, Alabama, which is just outside of Columbus, Georgia. The first park was bought in April of 2018 for $900,000 and the second in June for $2.2 million. Now, when they refinanced, the value was at $4.45 million. So they were able to double investors' equity in less than 18 months. So how'd they do it, right? Essentially, what this asset was a absentee owner. They weren't paying much attention to it. It was essentially being neglected. The community came with 101 park-owned homes that were not owned by residents. There was $200 per month with a partial recapture of water and sewer charges being charged for lot rent at the first community and $250 with no utility recapture at the second community. Now, what happened was, and the owner of the company basically told me that every Saturday was free car wash day. And so the whole community and surrounding neighbors would come to this park and they would wash all their cars because nobody was paying for the water. And so they actually had water and sewer charges, $7,000 a month, extremely high. And so a lot of waste was going on here. This is a problem, which of course we view as an opportunity. And so what our operating partners did was they installed smart water meters at each residence site right away. And now they're recapturing about 70% of the water sewer expenses by billing it back to the residents. They also repaved the roads. They put in a playground. You can see some of the pictures here. They do a lot of solar lighting throughout the community for safety and security. They added a barbecue and an enclosed mailbox. Really, you have to create a community feel. And so they were able to increase rents from the first park from $200 a month to $320 a month. And then the second park from $250 to $275. So they bought the communities for $3.1 million in April and June of 18, and they refinanced about 18 months later for $4.45 million. So that's a 42% increase in value in a pretty short period of time. They were also able to drop down the number of park-owned homes at acquisition from 101. There's only 9 park-owned homes today. So very, very substantial improvement. The vast majority of these homes were sold to residents through a rent-to-own program. So again, doubling investor equity in less than 18 months. All right, let's shift gears. We've gone through a lot of stuff, and in our executive summary, which you can view and access on our portal online, we've got a lot of FAQs. You can see a lot of the answers to common questions. There's a couple I want to run through. I won't go through all of them tonight, but we'll start with this first one. We anticipate distributions to investors to begin after the close of Q4 2022, if not sooner. Next, we're basically telling folks to plan for a period of 1 to 3 quarters from the time of investment for their respective preferred return to begin fully accruing. And this just allows time for us to select and invest into these assets and portfolios, but also for the portfolio's preferred return to begin accruing to our investment. And so we're going to be notifying all investors once a portion or all of the preferred return begins to accrue. Lastly, important to note, our financial projections have accounted for this expected schedule here. Okay, just to summarize, you can see again the offering with the different class shares, the projected returns. Again, you can log in on our website to view a lot more details, conversations with our operating partners, and the full executive summary. And we do have a relatively tight timeline, I guess, here. Friday, March 25th, which is next Friday, we're asking folks to fund by then. We've already accepted a good amount of capital and received from investors. Again, that is largely dictated by the portfolios almost being closed. And so we want to make sure we don't miss out on the opportunity. I think what we'll do now, I'll pause, and maybe Dan, you could open up for the questions that have been answered or asked at this point, and we can dive into them.
Yeah, sure. So first question is, I believe both operating partners have long-term strategy, but the operating partner 2 in particular assumes a hold beyond 10 years. So how would you deal with this at the SMK fund level?
Sure. So I think if I understand the question is, what if they don't sell? Is that essentially how I'm reading that, Dan?
Um,
Let
well,
me talk about it. Yeah.
I, I think he says correct. Yes.
Okay. Yeah. So a couple of thoughts come to mind here, and I can share those with you. But essentially, if somebody asked me, what's the perfect investment? What's the perfect duration? And it doesn't exist, but it would be an investment. You have to create it. You can't just invest into it. But it would be an investment where you have no capital in it, and you're still getting returns and cash flow. And so you have no risk. You've gotten your principal back. You can reinvest it into something else and compound your initial return on that money while still generating income. So that's the ideal, right? How many times can you do that over and over is really the goal, if you can. And both of our operating partners think the same way. And they are going to strive to grow value and return principal and continue to hold for cash flow. And so we anticipate that that is the likely outcome. We don't know. There's a lot of unknowns, variables, market conditions, et cetera, that could change. But having that philosophy and that mindset up front is really important. Both of our operating partners do. But essentially, we could, if people at some point said, look, I want out, it's been 10 years, et cetera, whatever the reason might be, we often have a redemption option where our offering documents will stipulate a process to get liquidity if we still have principal in the deal. And so that is outlined there. Our second operating partner has also noted the same, that if this is the case and they're not able to get all principal off the table and we're still holding for 10 years, then they would offer us a redemption as well. Next question, Dan.
Well, before we have any other questions, I don't see any other questions as of right now. I just think it's important to, kind of reiterate some of the benefits of these asset classes, given the environment that we're in, particularly surrounding high inflation, which,
Sure.
I haven't seen in my investing career. I certainly wasn't investing when I was, under 5 years old. So it's kind of a new dynamic for a lot of people. And, I think it's important to recognize that on the income side of the income statement, these assets can benefit from rapidly turning over rents and increasing rents because they have short leases. And then on the expense side, they're somewhat insulated against rising prices because utilities, CapEx, maintenance is generally on the lower side. So you're kind of you're really benefiting from inflation with these types of assets a lot more than, say, a typical real estate investment where, multifamily, for example, perhaps you have, utilities, water, etc., insurance costs that are generally cutting into your profit margins. So,
Yeah, valid point. We don't know of a better inflation hedge at this point. We believe very highly that these two assets are some of the best out there as far as options today.
and we have another question.
Sure.
It is, what is the black swan unknown that could put initial principal at risk?
Yeah, great question. So again, it's an unknown, it's a black swan, so you can take your pick. But I think what most people are coming to mind today is war. And so, I would say this: if the current situation in Ukraine and Russia escalates and other countries are brought into that conflict in a large way, in large capacity, who knows where it could go. And so we're watching that very closely, as everybody is. That is a concern. I don't anticipate that that's going to happen. We'll see. Hopefully that the future is brighter than the last couple of weeks that we've seen what's going on there. So that's one black swan event. I think some people would consider a pandemic a black swan event. That could happen again. We saw how the United States government and the Federal Reserve reacted during that time frame. Residents received a lot of stimulus through deposits into the bank account, direct debit cards, you name it, businesses as well. So there was a lot of injected capital into the system to the tune of trillions of dollars that we've never seen or experienced before. And so will that happen again? Could it happen again? It could. I think that prior to 2020, we hadn't thought about the idea of the government giving us money during a time of economic uncertainty and a recession and a pandemic. And so maybe they'll do it again. And that again, we don't know, but that's essentially, from my view, that reaction helped prevent a depression from happening in this country. If you think about what the pandemic resulted in, was everybody staying home, not working and not leaving their homes. I mean, that's the fastest way to turn off an economy. And so if that happens again, I anticipate the government will probably repeat some of the measures that we saw and experienced in 2020. And what we saw as investment managers across our portfolio was residents' ability to stay and pay. And there wasn't a lot of distress in the market at all, actually, in the asset classes that we invest in. So that's another one. Those are probably two that are top of mind today.
And kind of along those same lines, what's keeping you up at night these days?
My children. No, I'm just kidding. Yeah, no, they're grown enough. They sleep through the night. But no, in all seriousness, we're looking at interest rates. We're looking at the Fed's came out today, mentioned, which we all expected, that interest rates are starting to go up. We're looking at asset pricing. Not a lot of it keeps me up. I think that our strategy is well positioned for the next 5 to 10 years here because of the supply-demand disequilibrium that we see in these asset classes, which can really mitigate the risks of higher interest rates and inflation, of course. And so those are some things that we think about a lot. Dan, you and I talk about it all the time. We already reviewed the Fed's guidance this morning and this afternoon together. And again, it's not unexpected. The markets have already priced in interest rate hikes. You saw the stock market respond kind of positively, surprisingly, in my view, but I can't figure that out. So I don't invest much in that. But yeah, I think those are some of the variables today. It's just a time where a lot of people are chasing the same deals and there's just not a lot of opportunities. And so that is something that also keeps us up at night is, are we going to be able to continue to find opportunities to invest in that make sense, that we think have a really strong risk-adjusted return, that can be, pretty well insulated from volatility in the market in the next few years. We don't know what's going to happen, of course. And we just keep coming back to some of these charts that we share with you and also in apartments that we love to invest in, where there's just not enough of them. And that's a problem that's going to take many, many years to solve, if it's solvable at all. And we're seeing occupancy on apartments, for example, at the highest rate in record in some of these markets, even after unprecedented rent growth in 2021. And so that tells you something, right? You've got a situation here where there's not enough affordable housing in this country, and we don't anticipate that changing anytime soon. So we're trying to be the beneficiary of that too.
Okay. What will be the overall percentage of mobile home communities versus self-storage within the SMK fund?
So we don't know. The reason why is because not all of the assets have been acquired yet. And so we can estimate, and that's what we'll do. But the first portfolio today is mobile homes and self-storage. And it is, I think it's around 60-40, 60% valuation is self-storage and 40% or so is mobile home parks. And then the second portfolio is all mobile home parks. The first portfolio is larger, second one is smaller as far as total equity. So when you balance them out, let's just assume it's roughly 60-40 or so. Currently, I think we looked at this, Dan, but I'm just going off memory.
Yeah, that's
as
right.
to self-storage versus mobile home parks. So pretty well balanced. We're not going to project or assume what's going to happen. It's probably best to just expect that they won't be equal. It's not going to be 50-50. And there might be a little bit of an excess of value in one asset over the other.
This one's directed towards me. Would floating rate debt that the operators are taking impact returns if rates go much higher? So I'll say that higher rates are already baked into the forecasts, and the debt have caps on them. I believe the cap is SOFR at 300 basis points. So the all-in debt rate would be sub 6% in that case. And so a lot of that is priced in over time when we're looking at our returns already.
Yeah, just to add to that, we've been expecting interest rate increases for a couple of years, honestly. And so our operating partners are smart and they're building that into their projections. And so they're already expecting that, and we're putting that into our underwriting from day one across everything we do.
How does a recession affect raising rent across the properties?
Yeah, good question. So, I got into these asset classes post-recession, which was, 2010, 11 or so. And the reason why at the time I was looking at them was because I was trying to find a place to invest outside of what my family and our business were doing, where I could passively get diversification into other asset classes. And I went on like a 2-year networking binge in Southern California at the time, met a lot of really savvy people. A lot of those relationships stay with us today, and found that mobile home parks and self-storage at the time were doing well. They had done well through the recession. They maintained high collections, high occupancy. And the chart that I shared earlier in the presentation shows the net operating income growth through those downtimes. And so we find them to be the most resilient amongst options out there during recessions. Rent growth, good question. Rent growth can come organically through natural market appreciation, and it can also be forced through value add. And so it just depends on both what you're doing. If you're just sitting and waiting and hoping the markets will go up during a recession, it's best to assume that they're not and that rents will stay flat. But also, if you're adding a lot of value, you're implementing some of the measures we went through already to make a place more appealing, and then you can warrant a higher rent from what it was when you bought the place, because there's going to be more demand for it usually. And you'll also see, compared to other like kind assets, that your market rent is already higher, even potentially during a recession, than what it was when you bought it. And so it's a big part of our plan. We don't really know, of course, what's going to happen, but we do find that these asset classes tend to be some of the least volatile as far as rent growth goes during recessions.
With that, we have no more questions in the queue. I'll just throw one last question out there. Given that we're seeing all types of real estate assets trade at all-time low cap rates, you touched upon this a little bit in terms of competitive advantage, but I guess, is it really possible to find enough really good deals? And how can we find enough really good deals where we're not overpaying for these assets to get into the fund?
Great question. So that's what we do every day, Dan, right? It's 10, 12 years straight now of trying to find great deals. And so a lot of it for us is relationships. That's really where most of our deals are coming from, right? We're not on the MLS. We're not talking to brokers. It's other private equity groups that do one thing very well, that we have built relationships over the years with by investing with them, testing them, vetting them, underwriting them, poking holes in their thesis as much as we can, and trying to determine, if we feel that they are going to be great partners for us. And so today, that's how a lot of our deals come is, hey, Mark, we got a live one, or, would you guys like to participate, et cetera. So we'll vet it, we'll underwrite it. We also like the idea of being able to find deals. It's hard to do, but where we can get into assets and properties that were bought 6, 12, 18 months ago at those prices. And you saw that chart I showed you of pricing increase in 2021 is astronomical, right? Prices have gone through the roof. We all know this. So to have the ability to source opportunities where there's some assets that were bought prior to some of that natural market appreciation, and also have the ability to step into some of the value add that's been completed, really helps reduce risk of the higher asset prices that we're all experiencing today.
And with that, I think it's a wrap.
That's a wrap. Okay. Well, thank you all for joining us tonight. Appreciate your time. I hope you found it helpful. Again, you can get more information, and if you do want to make an investment as well, right through the portal on our website. Reach out with any questions. Dan, thanks again for the help, and appreciate it all. Thank you.
Good night.